Crypto prices go up and down, but smart investors make money either way. Here's how you can too. Let's face it, crypto is volatile. Prices can swing 20% in a day. One moment you're riding high on green candles, and the next, you're watching your portfolio dip like a roller coaster at Six Flags. But here's something most people don't realize. Volatility isn't just risk, it's opportunity. And smart investors, the ones who make consistent money in crypto, don't fear the ups and downs. They use them. They turn the very thing that scares others away, volatility, into monthly income. How? That's exactly what we're diving into today. We're not talking about trading coins every few hours or trying to time the top and bottom of Bitcoin. That's gambling with a fancier name. Instead, we're talking about strategic methods: yield farming, staking rewards, liquidity provision, covered calls, and of course, understanding the risks involved. So buckle up. Whether you're holding Ethereum, Solana, Avalanche, or even stablecoins, there are ways to make your crypto work for you every single month. Let's start with yield farming. If you've been in the crypto space even briefly, you've probably heard the term. It sounds like something out of a futuristic agriculture textbook, right? But yield farming is all about putting your crypto into decentralized protocols to earn interest, paid in the form of tokens. Think of it this way: you're essentially lending your crypto to a platform, like a decentralized exchange, and getting rewarded for it. This isn't too different from how banks make money off your savings, but in DeFi, you're the bank. Here's a real-world example. Let's say you deposit USDC and ETH into a liquidity pool on Uniswap. The platform uses your funds to facilitate trades. In return, you earn trading fees and sometimes governance tokens like UNI. In strong markets, some farmers rake in yields from 10% to even 100% APR, depending on the risk and token pairs. But don't let those high percentages blind you. Yield farming often involves impermanent loss, which is a risk we'll break down later. The trick is to farm wisely. Choose stablecoin pairs for safer yields, or use automated protocols like Yearn or Beefy Finance that optimize returns for you. Now, what if you're not ready to farm or manage LP tokens daily? That's where staking comes in. Staking is the gateway to passive income in crypto, and it's getting easier than ever, especially with Ethereum 2.0. When you stake your crypto, you're locking it into the blockchain to help secure the network. In return, you earn rewards, often paid out weekly or monthly. Platforms like Lido, Rocket Pool, and centralized exchanges such as Coinbase and Binance have made staking as simple as a few clicks. The returns? Typically between 3% and 10% annually for major tokens like ETH or ADA. Some smaller proof-of-stake coins offer even higher yields, though the risk grows with them. What makes staking attractive is its simplicity. You don't need to worry about trading, impermanent loss, or DeFi exploits. You're supporting the network and getting paid for it. Think of it like earning interest on a savings bond, but on your terms, and in crypto. But maybe you want something a bit more active. Something that taps into volatility directly and turns it into income even when prices are flat or slightly down. That's where covered calls come into play. If you're from the traditional finance world, you might be familiar with options trading. Covered calls are one of the simplest, most conservative option strategies, and yes, they work beautifully in crypto too. Here's how it works. You hold a token, like Ethereum. You then sell a call option on that token, giving someone else the right to buy it from you at a higher price within a set time. In exchange, you get a premium, a cash payment upfront. That's your income. Let's break that down further. Suppose ETH is trading at $3,000. You sell a 1-month call option with a strike price of $3,500. If ETH doesn't hit that price by expiration, you keep your ETH and the premium. If it does go past $3,500, you'll sell it at that price, but you still pocket the premium. Either way, you win, assuming you're okay parting with the asset at the strike price. Platforms like Deribit, Ribbon Finance, or even centralized exchanges like OKX and Bybit now offer simplified ways to sell covered calls. Some protocols automate this entire process so you don't need to be an options expert. Just deposit, set your parameters, and collect weekly or monthly income. This strategy thrives in sideways or slightly bullish markets, making it ideal during uncertain times. But let's say you're not into selling options. What if you just want to provide liquidity to earn fees and potentially a cut of the protocol's revenue. That's where liquidity provision enters the scene. Liquidity provision is what powers decentralized exchanges. When you add tokens to a liquidity pool, you're enabling users to trade without going through a centralized order book. In return, you earn a share of the fees generated from every trade. This sounds like yield farming, and it is similar, but liquidity provision doesn't always include token incentives. It's often just about fee income, especially in protocols like Curve, Uniswap v3, or Balancer. So how does this become monthly income? Let's say you provide equal amounts of USDC and DAI into a Curve pool. These are stablecoins, so you avoid most of the volatility. As traders swap between those coins, you earn a slice of the fees. In stable pools, yields can hover around 5 to 15% APR. Not bad for assets that aren't swinging wildly in price. More adventurous investors may add volatile pairs, like ETH/USDC, but must be aware of impermanent loss, which happens when token prices shift significantly and eat into your yield. But smart positioning or using concentrated liquidity strategies can reduce this risk while maximizing returns. Now, let's be honest, no strategy is without risk, and it's crucial to understand what you're walking into. With yield farming, the biggest dangers include impermanent loss, rug pulls, and smart contract bugs. You might be farming in a pool that looks great on paper, offering 100% APR. But if one of the tokens crashes or the developers vanish, your money could evaporate. In staking, your main risks are lockup periods and slashing. Some networks punish validators and stakers for downtime or bad behavior. And if you're staking directly on-chain, you might be unable to withdraw your tokens during volatile moments. That's why many prefer liquid staking platforms like Lido. Covered calls have their own risk. Your upside is capped. If the token's price surges way beyond your strike price, you'll have to sell it lower than market value. This can lead to regrets in bull markets. You earn income, yes, but you might miss out on huge gains. And finally, with liquidity provision, impermanent loss is the name of the game. If one asset in your pool drops or pumps hard, your net value could be lower than if you simply held the tokens. You're balancing between fee income and market shifts, and it requires close monitoring or use of strategies that hedge this automatically. So what's the best approach? That depends on your goals. If you're conservative and just want low-risk income, staking stablecoins or ETH through a platform like Lido might be your go-to. If you're a bit more hands-on and comfortable with options, covered calls can generate weekly premiums with minimal downside, especially in a sideways market. For the DeFi savvy, yield farming and liquidity provision offer the highest upside, along with the highest risks. The key here is diversification. Don't throw all your ETH into one farm promising 200% returns. Spread it across protocols. Use tools like Debang, Zapper, or DeFi Llama to monitor your positions and track yields. Crypto is no longer just about buying low and praying for all-time highs. It's about using your assets, making them work for you, and building consistent income streams, month after month. Think of it as building a crypto cash flow machine, one that works whether the market is pumping, dumping, or doing nothing at all. Imagine this. It's the middle of a bear market. Everyone's panicking. Prices are down 40%. But instead of sweating, you're still earning staking rewards, your liquidity pools are generating fees, and your covered calls are bringing in weekly income. That's not just smart investing, that's financial resilience. So what are you waiting for? Whether you've got $500 or $50,000 in crypto, it's time to stop watching the charts like a hawk and start building systems. Systems that generate income while you sleep, while you travel, or while you wait for the next bull run. If you're serious about turning crypto volatility into monthly income, now is the time to act. Don't just hold, earn. Don't just speculate, strategize. And remember, crypto doesn't reward the lucky. It rewards the informed and the disciplined. If this helped you think differently about your crypto strategy, drop a comment, hit that like button, and share this with a friend who's still holding tokens in a cold wallet, doing absolutely nothing. And of course, if you want more crypto income tips like this delivered daily, make sure to subscribe, Create My Route. Let's grow smarter together.